Mohan here, good morning, and I'm just going to do a recap of the Boomerang Currency Scalp Trader. We're only going to be trading between the hours of 10 o'clock and 2 o'clock Eastern Standard Time. So notice here, this is a Pacific Standard Time chart, so when the chart opens up here, we got 7 o'clock coming in, we get a sell signal with a sell channel opening. Now, one of the rules is that the candles here must at least hit the orange bar before we get a signal. So right here we get a signal at 5:01. So let's subtract 2 ticks for slippage. Let's say 4.99 is our entry on our short. Prices went to 0.3, just a few ticks against us, no big deal. And then boom, down here for a nice 8-tick gain. Now every 8 ticks is $100 in your pocket. So we just want to scalp the safest trades we can each day, 3 to 4 to 5 times a day, make a nice living for ourselves. Okay, we got the next signal here at about 10:30 Eastern Standard Time, hits the orange bar. We get a bounce up here and we get a buy signal at 0.4. So let's say 0.6 on the slippage. Now, what happened here was the market ran up because we were a little late in the sell channel. They ran up to 15. So if we indeed got short at our long at 0.6 and they ran up to, looks like the high here was 14, that would have been 8 ticks. You might not have gotten filled. The pullback was to 97, so that was no big deal, just few ticks against us, still above the channel here. Then they ran up, and indeed we got what is called right here a bias acceleration signal, so they ran up and gave us another 8 ticks. So we're now up $200 on the day. With this red line crossing over the orange, this is a signal not to take shorts against that trend unless the bars start trading below orange. So we would have ignored this sell signal. We got a buy signal here with a second level buy. We would have taken that. We've got long here at 30, and then we're going to add 2 ticks, so say 32. They ran up to 40. Again, 8 ticks. Right at 8 ticks, might have got filled. You might not have. You may have caught this right at 30. Would have got you filled for 8 ticks. Otherwise, we're at, what did we say here? 33 long approximately. We would have still, no, this one would have got stopped out if you got long at 33. If you got long a little higher, lower, you would have still been in the trade. But either way, let's say we got stopped out on that one, no big deal. We're waiting for our next trade here. So now we get a short signal, bars tapping here, short 23, 29 high, and boom, down they go. Now we had a bias acceleration signal here on the sell side as well, so we could have held that trade for more on all of these where the bias accelerator agrees. Generally, you need to stack up the other figures. Now, notice in the bottom, these are our bias histograms here. You want all these matching. These are okay if they're gray. It just means under the zero line here, and these under the zero line are going to be red. Above the zero line are going to be green. So we just want these to be matching. That's going to give all the force to the trade on that side of the 6E. So as we roll along, we had another trade here. As mentioned, we're under the orange line. There was no tap, so there's no signal there. We get another signal to go short. The price would have been 69. Let's take it down to 67 for the slippage. 67 would have held 12 tick stop, and down to 54. So now we're up approximately 300 or so on the day, and we're waiting for our next trade signal. We got it here with prices after an extended move to the downside. Remember, when they get an extended move like we saw here, get ready to get long again. We get taps on the orange line. We get a signal here at 76. Let's say it was 78. 68 held, and up they went. Again, a bias acceleration signal here. That takes us right into 11 o'clock. So for about a $300 to $400 day, depending on how much you got stopped out on that other trade, we had 4 gains and 1 small loss for a nice day.